A diversified income portfolio is key to financial security in retirement. Relying on a single source is risky. Diversification balances income stability and growth. Annuities can provide guaranteed income, with fixed annuities offering security and variable annuities allowing market participation. Dividend-paying stocks generate income while retaining some growth potential. Bonds, including treasury, corporate, and municipal options, provide stable returns with varying risk levels. Real estate, through rental properties or real estate investment trusts, generates income that can rise with inflation. CDs, high-yield savings accounts, and income-focused mutual funds, or ETFs, offer low-risk options while keeping cash liquid and accessible if needed. A well-structured portfolio blends these assets, aligning with your risk tolerance and income needs. Proper diversification supports steady cash flow, reduces volatility, and sustains long-term financial independence.
Wade, you've explored the trade-offs between protected income and market-based income. How can retirees determine how much of their portfolio should be in guaranteed income products like annuities?
Well, it's ultimately going to depend on their style, but the way I like to approach that is first assess how much reliable income you already have. And so Social Security is going to be a big part of that for many people, and delaying Social Security can really enhance the reliable income available to the household, whether there's other pensions and so forth. And then compare that to what is the fixed basic essential budget you'd like to be able to meet over your lifetime. Now, if there's a gap where your reliable income doesn't meet your essential spending in retirement, then that's where the conversation begins about how would you like to fill that gap and how much would you like to allocate to reliable income sources. Now, if you take more of the total return investing perspective that you're going to draw from a diversified portfolio and you're comfortable relying on the idea of market growth, you may not really look to annuities or other kinds of reliable income resources beyond what you just already have by default. On the other hand, though, if you have more of a time segmentation style, you might look at creating a bucket for short-term funds to cover upcoming expenses and fully meet all your essential spending need. And then if your style's more what I call income protection or risk wrap, that's where you might look to an annuity with lifetime income provisions to help fill that gap. And if it takes what you feel is a reasonable percentage of your asset base to fill that gap, you might be able to feel more comfortable and sleep better at night knowing that you have a sufficient floor of reliable income.
I like thinking about it in terms of style. Bill, you've emphasized the importance of equities and stocks in maintaining long-term purchasing power. What's your perspective on how retirees can stay invested without overexposing themselves to market risk?
Well, that's really an interesting question, and I could probably speak on it for a very long time, which I'm not going to here. But my research indicated that if you're using a withdrawal method, which basically increases withdrawals with inflation, that your optimum allocation of stocks should be somewhere between 45% and about 75% stocks. If you stay within that range, it really doesn't affect the withdrawal rate at all, which is kind of amazing. That was one of the first results that came out of my retirement research way back in the early 90s. So you need to keep that healthy allocation to stocks, because if you get too much, you overexpose yourself to stocks, and in a major bear market, your portfolio can be devastated. That'll reduce your withdrawal rate. If you have too much in bonds, not enough in stocks, your portfolio won't have enough oomph, won't generate enough return, and will fall short at the other end of the spectrum for that reason. So somewhere in the middle, about 55, 60% is probably ideal.
Has there been some talk more recently about adjusting the glide path? So starting retirement with a lower percentage to stocks than what was previously, conventional?
Yeah, in my book, I've studied that in detail, and I found out that that idea, which was developed by two other advisors, Wade, I think one of them, and Michael Kitces, was a very successful concept. If you started, let's say, with a lower equity allocation, you might otherwise, let's say 35%, increase it by 1% a year. In almost every single case, for every retiree I've studied, they benefited with a higher withdrawal rate significantly, using what's called a increasing equity glide path. I know that's a very counterintuitive result, but it works. And my job is not to decide what I like and what I don't like. It's what works and what doesn't.
Follow the data.
Yeah.
Wade, how would one do that? Do you make the adjustment in your tax deferred account?
Well, there's a lot of potential ways to do it for when it resonates with an individual. But yeah, it was really, so Bill Bengen's research gave us the idea of sequence of returns risk in retirement. And that's why market volatility really matters. The rising equity glide path idea was meant to provide one way to manage that sequence of returns risk, that you have a lower stock allocation early on in retirement when you're the most vulnerable to volatility. But then over time, volatility will have less impact on the sustainability of your spending. And so increasing the allocation over time, maybe in the first 10 to 15 years of retirement, to get up to what you view, like Bill Bengen was saying, that maybe 50, 60% stocks for that later part of retirement afterward. One simple way to do it is you just build a front-end bond ladder. Say the first 10 years of retirement, I'll have bonds maturing every year and I'll spend those and I won't replenish them. And so as that bond ladder gets spent down, that's a feasible, practical way, and probably the easiest way to think about starting with that bond ladder fully in place at the beginning. You have a lower stock allocation. And then as you spend down that bond ladder, your stock allocation goes up to the level you'd ultimately like to see it at.
It's a really interesting idea, because I think most retirees, they're worried that as soon as you retire, what if it's a year 2000, and that's going to impact how your retirement plan is going to be functioning right at the start. Dana, maybe you can talk a little bit about, I know that you advocate for balancing income certainty with flexibility. How do you tailor portfolios differently for clients in their early retirement years versus later years?
Well,
yeah, it's interesting. We do exactly what Wade said. We build front-end bond ladders. As a matter of fact, I have a paper on it illustrating that particular scenario over two different retirees in different historical periods. It's called the wind down, managing risk in the retirement red zone. It's available on the Investments and Wealth Institute's website, but it can be great for people who want to see an example of what it looks like to build a bond ladder and how that looks in action. But we do that for every single client. We've been doing it since 2012. Now, it does get customized to their situation. And so what typically happens now, we have, 13 years later, we have clients to see how their allocation has evolved since they first retired. And we had many who retired not in 2000, but in 2007, right before the Great Recession. And so we can see exactly what Wade is saying. As we've spent some of those bonds that have matured, we've also been able to continue to add bonds to make sure at least 5 or 6 years of their future income is covered by maturing investments. But the equities have grown enough that they have experienced a rising equity glide path. Maybe they retired with about 60% equities, and right now they're sitting at about 70 to 72% equities. And we have a process for monitoring that. So when the equity allocation gets over specified threshold amounts, then we sell some of those equities and again, add on to their bond ladder. But it works really well when the market goes down. For the clients that really understand the process, we have actually gotten thank you emails saying, thank you so much. I understand that my income right now isn't impacted by this current market volatility. I understand how the bond ladder works. So it helps bring peace of mind. That's how I look at it. It's a strategy that people understand, and it really helps bring peace of mind.
Are you keeping the stock allocation as is at the start of retirement, or are you dialing that lower going into retirement?
We are measuring by the number of years of cash flow covered. So it's not a traditional rebalancing model of looking at stocks versus bonds. It's really looking at where is the most risk, which is that retirement red zone period, the 5 years before and first 5 years of retirement. And it's not quite to the extreme. Kitces has an article on building a bond tent where you would bring your equity allocation down to perhaps 30 or 40%. We're not that extreme, but it is saying I do want a longer bond ladder. Maybe it's to cover the bridge between when Social Security starts, but really to cover those riskiest years. As you get later in retirement, we have more data. We have 5 or 10 years of retirement in the rearview mirror to say, okay, we didn't get a worst case scenario. You are ahead of the path where we thought you would be. So maintaining such a lengthy bond ladder isn't as critical anymore. And so again, it's not a strict rebalancing to an allocation model. It's conversations with the client and making sure we're maintaining a specific income ladder. And as people get into their 80s, we actually like shorter, what we call thicker bond ladders, because life expectancy is not as known at that point, and we want flexibility for heirs. So there's all kinds of factors that come into account when we're applying it. It's a general concept, build a bond ladder, and then it gets very personalized at the household level.
If I could jump in there for a second, I know Wade always talks about the retirement income investing styles, and I went through his style box, which I think is brilliant, and figured out that I like the idea of a risk wrap, some sort of guaranteed around my investments. And I consider myself semi-retired now. And the way it worked for my husband and I, he is a retired federal employee. He has a pension, but he paid into Social Security the whole time. So he and I both have Social Security. And rather than having a bond ladder, we had some variable annuities that we bought many years ago that had guaranteed minimum income benefits that are very generous. So we use that for additional cash flow. And essentially, we have not yet touched our diversified investment portfolio. So much like Dana's clients find during market volatility issues, I don't even think about that because those investments are for the long term, and my immediate and near-term income needs are covered. So I sleep pretty well at night. So thanks to all the brilliant researchers and practitioners here that have made all of these strategies possible. If it wasn't for each of you, retirement could be a scary place for some people.
Appreciate your sharing your personal real life example. Mary Beth, what do we need to know about Social Security? Are there fewer creative strategies available to us today?
Yes, so many of the creative claiming strategies have disappeared after the last group of eligible retirees had turned 70 a couple years ago. So right now, basically your decision is when do I want to claim benefits? I can claim them early as 62, but if they're permanently reduced by as much as 30%. And if I continue to work while claiming benefits before my full retirement age, I'm also subject to earnings restrictions. This year is about $23,000 a year. Earn more than that, and you could temporarily lose some or all of your Social Security benefits. Earnings restrictions go away at full retirement age. If you claim at full retirement age, you get 100% of those benefits that you have worked so hard for and paid so much for in the form of FICA taxes. But for those who are healthy enough and wealthy enough, frankly, to be able to delay claiming Social Security up until age 70, there is this huge payoff of an extra 8% per year for every year you delay between full retirement age and 70. We know there are long-term financing challenges to Social Security when the trust fund reserves are expected to be exhausted sometime around 2033. That does not mean Social Security is bankrupt. There would be enough ongoing FICA tax revenue to pay about 80% of promised benefits at that point. But frankly, no one is going to be satisfied with 80% of promised benefits. There are many things Congress can do in terms of tweaking benefits or raising tax rates or raising the amount of wages subject to FICA taxes to put this system on a sustainable future. My bigger concern more immediately is concerns about the delivery of customer service, where the Social Security Administration is understaffed and underfinanced.
Is it true? I heard you mention the statistic that Social Security claims reps did not give the best advice, something like 82% of the time.
That was several years ago, a report from the Social Security Administration's internal watchdog had found that when it came to survivor benefits, many people are entitled to their own retirement benefit if they've earnings history. And if their spouse dies, they may also be entitled to a survivor benefit. Those are two different benefits. In many cases, you can choose one first and switch to the larger benefit later. And often the benefit is to wait for the survivor benefit, because for many couples, that's the bigger benefit. And in 83% of the cases, the Social Security rep at the time did not offer those two options to the beneficiary. They suggested they take one or the other, and many people didn't realize they had a choice.
Okay, so a little bit less applicable today, but it still pays to do your homework.
Well, also, it is true today that in most cases, when people file for Social Security, and if they're entitled to more than one benefit, they have to take the higher of the two. They don't get a choice, except when it comes to survivor benefits. Survivor benefits and retirement benefits remain two separate pots of money. And depending on your age and circumstances, you may be able to claim one first and then switch to the larger benefit later. And that's still a viable strategy.
Okay, so it depends on your health, wealth, and your marital status. We're going to move on to segment 3 and talk about tax-efficient withdrawal strategies.